All right. Good morning, ladies and gentlemen. Welcome to MACROACE with your host, Tony. Also the head financialist of FinancialJuice. Let's go into it. CPI, very important release for the week. And also before we get the next Fed rate decision. But also how the markets reacted. What have they been trying to do? Have they been trying to prepare themselves for a hotter than expected CPI, or maybe a much cooler than expected CPI report? So that is something that we're going to kind of go through sentiment wise as well. Good morning to you all. All right. So what is CPI if you don't know what it is? It measures how much consumers are paying for goods, retail goods and services. And the way it's measured is you have 26,000 retail outlets, 4,000 housing units in 87 urban areas, and prices are collected on 80,000 different goods and services by people who will go to the place, to the store, or to the office, or to kind of see what prices are like and how much they've changed over the last month or so. And then, of course, they have the yearly measurement as well. Then the key measurements for the CPI report as well. So housing represents the majority of the report, about 42%. Food and beverages, about 14%. Transportation, 18%. And medical care, 8.5%. So there's quite a bit of a weighting behind the housing part of the report. That's where the majority of the inflation has come from. But we know in the past, what we've seen is that energy prices used to be last year the biggest annoyance for the CPI report. But now that the energy prices are coming down, everyone's focus will continually going down. Energy prices have now shifted. It's now shifted to the thought about what are services doing now? How strong is inflation in that area? So that's what we're going to try and see in the next report, as to see how strong services inflation is, which is what the Fed have been citing as a potential issue for ongoing sticky inflation. Now, of course, as you know, core CPI excludes food and energy. And then the data that when we're not looking at inflation and the Fed's goal and what they want to do with it, usually the seasonally adjusted is the preferred bit of data, the month-to-month data, because that's what traders like. They get a clear idea as to what's going on in the economy without the effects of weather, production cycles, etc. And that's more of a clearer. It gives them a clearer understanding as to how strong inflation has been within the last month or so. But of course, all the bits of data for inflation are going to be important today, because one point of data could rock the markets if it is much higher or lower than expected. Now, the difference between PCE and CPI price index. So the PCE price index is the personal consumption expenditure, which places a lower weight on prices of gasoline and of residential rents, and focuses on the nation as a whole rather than just focusing on urban areas. So this is a thing so another way to simply put it is the CPI, as said, measures urban areas only, which is where most of the spending occurs. But then the PC price index focuses on the nation as a whole. So that's the key difference, and that's why, of course, usually, not within this tightening cycle, but usually you see a little bit of a difference between the PC price index and the CPI price index when the economy is in more of a normal state, when there isn't hiking cycle or rate cutting cycle. So that's also another thing to consider too, as to where we are at the moment in the cycle of the hiking path. I know we're getting towards traders know that we're getting towards the end of the hiking path of the Federal Reserve. Some are looking at the federal funds rate being between 5 to 5.25%, and that's continually been going up since the Federal Reserve have started to raise their rates from March, before the expectation where the terminal rate is going to ev up. All right, so now how does it affect the markets? So the dollar tends to strengthen when the economy is growing, and today, if we do get very strong inflation data, that would add to the fuel that the Federal Reserve is going to hike for longer than expected, so the dollar would climb further. For the stock market, underlying inflation, particularly the core CPI data, usually in a normal environment, when that rises sharply within a month, that can lead to stocks taking a hit. But anything much higher than expected for the CPI report, if all the data is higher than expected, rather than coming in line with expectations, that would be bad for the stock market, because of course that raises borrowing costs higher, or the potential for borrowing costs to go higher, and businesses will take a bigger hit further down, will take a bigger hit as the interest rates start to rise. Then you've also got to think about how the bond market works as well. High inflation rate can also lead to high yields in an expansionary environment. But we've come to the point where the bond market and sentiment of the bond market is very key too. I've talked about the yield curve inversion and how that started in November of last year, when the 3-month then became higher than the 30-year yield. Usually so that's an inverted yield curve, and that denotes that there is the expectation of a recession that's going to happen. But some traders and some analysts had said that, well, actually it's the bond market's pricing in that the Federal Reserve may cut rates sooner rather than later, or it's so there are those two views there. I'm more leaning to that there might be sort of a mix of the expectation of a recession coming along, but it could be shallow. But then on the flip side, I also think that maybe the Federal Reserve could start to cut rates sooner if the economy does start to falter. So it's more or less a waiting process that we have with the Federal Reserve and the economy. Or should I say the economy first and then the Federal Reserve, to see what they do in response to what the economy does. So if there is a slight downward tick in the economy, or if there is a recession, be it shallow or deep, then the Federal Reserve could act sooner rather than later to try and offset that. If inflation has substantially come down to their 2% target. So they've got a mixed bag to kind of deal with. But a lot of the focus still sits on how the Federal Reserve is going to get inflation down, without really thinking too much about what the jobs market is doing. We saw the jobs market, with the last report we had for non-farm payrolls, which had a 329k deviation at 517k, right? So 500,000 jobs being added within the economy within the month. That's also so if the economy can still kind of withstand itself without being affected too much by the rate hike of from the Federal Reserve, then the Fed can continue raising interest rates to where they need to be without having to affect the economy that much. That's another point of view there. Now, the previous report then, so the all items index increased 6.5% for the 12 months ending December, which was the smallest 12-month increase since the period ending in October 2021. The month-to-month index for gasoline was by far the largest contributor to monthly all items decrease, more than offsetting increases in shelter indexes. Now, as I said, the services side is going to be important to look at. So that's at the bottom here, where services less energy services, and you've got like energy services here too. That we're also going to be kind of energy services. We know that energy prices have been coming down quite a bit. So it's more or less, you were looking at services excluding energy services. That's going to be quite interesting to look at. So now that we have this here, if it's at 7.0, it's going to be key to kind of keep an eye on if that continues to rise, and that plays into what the Fed members have been saying in the past, that services could become a sticking point for inflation. So if that continues to rise, when you don't see a substantial decline, then that could mean that it makes it harder for the Fed, or maybe the Fed could raise rates for longer rather than more than expected. But just going off of the services side, if the rest of the inflation report is lower than expected, then that could mean that the Fed might not have to worry so much about the services side of inflation, and just understand that you do have a declining inflation overall in the US in the urban areas. Right. So the economy at the moment. So this is also quite key to understand what's affecting the market sentiment. What is... Oh, yeah, sorry. Yes, I know. I took my pointer off. I should have put that back on. But you could kind of see it. Hopefully, you could kind of see it at the bottom. You could see the bit where it says services. So, non-farm payrolls then. So what we had last time around, as I said, there was 517,000 jobs that were added versus the prior of 223k. The unemployment rate also ticked down 3.4% versus 3.5%. Average hourly earnings, average earnings year on year was also ticked down. Another key report, forward jobs report, 4.4% versus 4.9% as the prior. Employment costs were also down at 1%. Prior was 1.2%. PC price index was also at 5% versus the prior 5.5%. Core PC price index was at 4.4% versus the prior 4.7%. ISM manufacturing prices paid was at 44.5% versus the prior of 39.4%. So a bit of an increase in the manufacturing sector with the prices paid. And then the ISM services prices paid was at 67.8 versus 67.6. Just to let you know, if you're putting figures in the chat, no, the figure has not come out yet. We've got about 18 minutes left till the release is expected to come out. So just to let you know, 8:30 a.m. Eastern time is when the release is. Let's not try to confuse each other, people. Come on, let's play fair. Productivity was at 3% versus 8%. Import prices at 4% versus the prior of minus 0.6%. Export prices was at minus 2.6% versus minus 0.3%. The PPI report, which we're expecting this Thursday, PPI year on year was at 6.2% versus the prior of 7.4%. And the core PPI year on year was at 5.5% versus the prior of 6.2%. All of these bits of data are important to understand how strong is the inflationary pressure within the US economy. And overall, you can see that inflation has come down substantially. And even with the smaller reports like the employment cost report, which nobody really looks at that much, had a big effect on the market when it came in lower than expected. Okay, the forecast was 1.1%, but it came in at 1%. And the stock market lapped that up and loved it. So even with a small report like the employment cost data, which of course the Fed is keeping an eye on for how strong are wage prices within the economy, even something as small as that, which doesn't garner too much attention, still means that inflation is still very important to the market. And if there is a deviation or a big deviation, then you get to see the markets either lapping it up or taking a big hit instead. All right, now. So the triggers end for the economic release. Now this is what economists are expecting. So the month-to-month, they're looking at a high estimate of 0.6% with a low estimate of 0.3%. Of course, the median estimate is 0.5% for the CPI month-to-month. The year-on-year, the headline figure that we're going to be looking at today is at 6.7% with a high estimate, with a low estimate of 5.8%. So they're looking for a 0.5 deviation on the high end and a 0.4 deviation on the low end, according to economists' expectations. That's quite a big gap compared to what we've seen in the past of high and low estimates, where they've been in the range of maybe 0.2% deviation or 0.3% deviation expected on either side. So what they're saying is, if there is a surprise, they're expecting inflation to go down, but they're not expecting, it'll take quite a lot for the markets to see a surprise in the figures. But I think when we look at the deviations, I'll show you why that could be a different picture instead. Core month to month, there's a high estimate of spot 5% with a low of spot 3%. Core year on year with a high estimate of 5.7% and a low of 5.2%. Now, the sentiment and views then. What is going to be quite key? What else is driving the markets? So JP Morgan CEO Dimon said the US rates may go higher than 5% if inflation is sticky. It is perfectly reasonable for the Fed to hike rates to 5% and wait. Then Bank of America, they also said that the inflation data will mark a turning point in the equity rally at a time when investors are swapping stocks for bonds amid the threat of a recession. So remember when I talked about the yield curve and the inversion, when bond traders start to get scared? If you've watched my previous videos in the past about how the markets, or the history of the markets, and how you can kind of see when a turning point might happen in the market, or you might get an inclination. Usually what happens is the bond market peaks before the stock market does, okay, before a recession. And then when the bond market is down, then it takes quite a while for the last 2007 to 2009 recession, it took quite a while for the S&P to follow suit with the bond market as well, to then fall down or see a decline as well. So this is something that Bank of America is, touching on here, that, if inflation, if inflation is much better than expected, i.e. for the stock market, if it's lower, let me make my language clear. If inflation comes in lower than expected, right, that's going to be positive for the stock market. And then the threat of a recession is kind of withers away a bit more if the Fed doesn't have to do that much more work to try and bring down inflation. So that's one thing that Bank of America is trying to highlight there. But again, it's quite difficult to see it could be difficult to see a different way if the bond market is flashing red and saying, hey, there's going to be a recession pretty soon. But again, it's more or less waiting to see what the data does and how well the rest of the US economy performs, or it's how long it takes for the US economy to actually go into recession, and to see if bond traders were right all along, or if they were just kind of waiting to say, aha, I told you so, there is a recession a year later, if that happens. Right. Let's carry on. So Harris said that for most central banks, the risk is that they have tightened too little, not too much, and the ultimate gauge of success is getting inflation down, not avoiding a recession. Again, Harris from Bank of America saying that the Fed's job is just to bring inflation down. If a recession happens, it's going to happen. It needs to happen to really cut off spending within the economy as a quick sure fire way of getting inflation down much quicker than they would if the economy was still trudging along nice and slowly with strong jobs data or strong manufacturing and services data. So it's better to cut the economy's, kick the economy in the kneecaps. I was going to reference a mafia thing, but I'm not going to do that. Don't want to get demonetized. So yeah, if better to hit it at the kneecaps and let it wobble, and then it slowly climb up and come back up in a nice slow way, enough for you to be able to control it. Even that sounds like a mafia thing. Yeah, so by the bond market, what I'm talking about is the yield. So the price, I'm not talking about the price, I'm talking about the yields within the bond market when I'm talking about the yield curve. So remember, the bond yields will usually see a movement towards the upside if inflation in this scenario is higher than expected, because that leads to the expectation for higher rates. But if you do see, but for bond prices, of course, it's the inverse relationship. The bond prices will go down. All right. So sensitive 2-year Treasury yield. So this is also something that we're talking about, the bond market as well, and how the long-term rates may be starting to are still climbing a little bit higher. So you had at the beginning of the month, the 2-year yield was at 4.08%, but around 4.51% Friday, 10th of Feb. So that's another key thing to be aware of is, okay, the bond market is flashing that there is an inversion in the yield curve, that there is a problem, or there is going to be a recession, but the longer term rates are showing more of a mixed bag of what's kind of going on within the sentiment of bond traders. If they're feeling that, yeah, there's going to be a recession, but then the long term rates start to tick up higher, and then you start to get a flat yield curve, where then policy changes usually kind of occur, and the yield curve goes back into its normal, and then it goes back into an upward slope. So it's a bit difficult to gauge, what bond traders are really feeling. If you have those two bits of sentiment of potential rate cut or easing in the monetary policy, or how much they're expecting, what's the probability they're expecting of a recession if it is expected to come soon. Now, then you have the UMich survey, 1 year ahead inflation, which rose to 4.2%. That's one concern for the markets from the consumer's point of view. If they feel that inflation is going to be higher than they had seen, or had been than they had seen in the past, that does muddy the picture. But it all depends on, again, today. You might cause a little bit of a scare within the markets with the 1 year ahead inflation from the UMich survey, but today it's CPI. So, all right. Trappist says 29 this became a must do every month. Hey again, Tony. Hello to you. Somebody said could be sell. Somebody said lo-fi Leli said let's go Tony. And Bricktop said I am scared. Now, please, don't put figures in the chat. Don't put people off. Come on. What are you guys on about? If you have some insider information, that'd be great. And if I had a phone line direct or red hot an emergency hotline to Powell, I'd probably use that thing every single day if I wanted to. Fed and government views. So Fed's barking said inflation is certainly past its peak, but remains elevated, and it will take longer for demand to lower the pace of price increases. Waller said interest rates may stay high for longer than some are expecting currently. Kashkari said most of my colleagues believe rates will rise above 5%, and that it's certainly possible that they will rise even higher. Powell said the message, so Powell had a big influence on the markets not too long ago. So the message from the last week's FMC was that disinflationary process has begun, but there is still a long way to go. If strong labor market reports or high inflation reports continue, the Fed may need to raise rates more than is currently priced in. So again, from Powell, he rocked the markets a little bit, and he had seen the big, huge movements going up and then down. Post Powell's comments. So, again, we're going to see, it's not just the CPI report to look out for. Of course, we had the non-farm report last week, but when that does come up again, that's going to be very key to keep an eye on. Yellen said that inflation remains too high, but is coming down. Their market pricing, so January 12th, Fed swaps show less than a 50 basis point combined hikes for February and March. Of course, we had the 25 basis point hike in February, towards the beginning of Feb. February 3rd, post NFP, Fed swaps priced in peak policy rate higher than 5% in 2023, and they rise as high as 5.07% for June 2023 contracts. And then if we go ahead, investment bank estimates. So Goldman Sachs, I might have to so here you go. So Bank of America seeing 6.1% for the year on year. Goldman Sachs seeing 6.4%, and JP Morgan 6.2%. I think we might have to kind of go through these, but the core year on year, they see 5.6%, JP Morgan 5.4%, Bank of America the same as well. Right. Now, this is the last report that we had seen last time around. So this is 10 seconds before we had seen 10 seconds before the report on January 12th. And I'll kind of, so one thing to be aware of is how the markets are very sensitive to prior the release. Okay, and you can see before even the figures come out, the markets are trying to move, and then bam, figures come out, data is in line as expected, but it didn't go further down. That's why it's seen the dollar, which had seen a move towards the upside. Okay, the only issue is that the dollar really didn't hold on to its gains that much. So let me go through them again. So the data came in as expected. It didn't come in lower than expected, which is what the stock markets were expecting or wanting it to do. That's why you'd seen that bit of the sell-off there from the S&P 500, and a bit of that jump from the dollar. But if we kind of skip ahead, and we see how the market starts to reverse pretty soon. Okay, so the release happens, but because the data was in line with expectation, it was still lower than the prior figure. So inflation is still coming down, but just not as strong as what the economists were expecting. Okay, so we've got about 4 minutes left till the actual release. Remember, this is just showing the prior release. If you've just jumped on, yeah, it better not be a Valentine's Day massacre in the markets. Depends what kind of a trader you are. Maybe you're a dollar trader. If you're a stocks trader, you're bond, you never know. Just got to know. Bleeding red for you, pal. Maybe. We'll see what it's like today. But that was the last release there. And we'll kind of go forward a little bit. So yeah, it kind of reversed sooner than markets would normally expect, or try to reverse sooner than markets would normally expect on the S&P 500. But it didn't stay. It didn't have a shoot, an arrow, a line going, and a candle going all the way, going down and constantly going down. So it meant that the deviation wasn't strong enough, is what I'm saying. For the markets to say, okay, so let's look at the deviations quickly. So this is off of the last release that we had, as said here. Now you can see in the past, when there has been a clear deviation on whether it be up or down with a figure, you have a stronger market reaction, okay? And that market reaction, that initial reaction, whether it's going up or down, lasts for longer rather than a short amount of time. So here we can see you can hopefully see that what I've just highlighted here on the last release, which should have said January 12th, by the way, not December 13th. But you can see here that the last release, when the data was in line with expectation, you had still seen a decent move from the markets initially on the first candle. This is what this number represents here. Okay, this is the initial candle going to the wick of the candle, because I always like to capture the initial move. We've got less than a minute left. Let's kind of go out of here. Right. Delete. Right, let's go. Okay, we've got about less than a minute left to the release. So, better than expected report, or higher or lower than expected report will create more volatility. Higher than expected report is better for the stock market. Excuse me, higher than expected report is better for the dollar. A lower than expected report with lower figures is better for the stock market instead. So let's have a little look. Right. Okay, 10 seconds. Let's see what we have here. And the markets are trying to move beforehand. So dollar yen, S&P. 6.4%, 6.4% higher than the forecast of 6.2%. CPI month on month, spot 5%, spot 5% as expected. Core CPI year on year, 5.6%, 5.6% higher than expected, higher than the forecast of 5.5%. Core CPI month on month as expected at spot 4%. So data was mixed, but there was an overall movement, overall higher than expected report for the economic release. So the dollar yen is having a nice time. The S&P is not having a good time. Let's see what's going on. Right. So dollar yen. All right. Let's have a little measure with the dollar yen. See what you got here. Okay, that was 89 pips, or 18, or you could say 90 pips, or 89 pips there on the dollar yen. And if we're looking at the S&P, let's see. Okay, 107 ticks down. Let's look at the Dow. So, yeah, the data came in higher than expected for the headline figure by 0.2%. And then, on top of that, you had data that wasn't, there wasn't anything, there wasn't that much of a deviation. There weren't any deviation with the other two figures, CPI month to month and the core month to month. There was the year on year and core year on year that had actual deviations but were higher than expected. So inflation is still coming down, but the only problem is it was higher than what the analysts were expecting. Hence, you're seeing this market reaction here as well. Now, let's kind of see what else is going on. Within the markets. So let's measure the dollar yen. We've already measured the dollar yen. Let's measure the euro USD. Okay. Right, that was 38.7. 38.7. I'll show you what that is. Right. Okay. And prices. 2 years as well. See what that's doing here. Okay, so that's 44 ticks there. Let's look at gold as well. Oops. Let's keep an eye on what that's doing. Okay, and gold had 137 ticks there to the downside. Somebody said dollar CAD. Let's have a look at dollar CAD. Yeah, let's bring that up. Let's see. Let's see what we got. Oof. Okay, so yeah. All right. Still interesting to look. Oh, let's bring it down a bit more. Okay, so Fed funds futures reverse early losses, now slightly up as traders assess inflation reports. Let's also have a look. Okay. Right. Yeah, it is sticky inflation. Okay. Now, that more or less concludes the data. So Fed Fund futures now pricing in top Fed funds rate of 5 to 5.25% by July versus earlier near even odds seen of higher Fed funds rates. So more or less there's no change to the expectation that much. So traders were worried about what the inflation report was going to do, and it didn't do too much because evidenced by how the market reacted. So initially, yeah, you had the move down, but then the data came out. Although it was worse than you did have 2 points of data that were worse than which were higher than expected. Sorry, when I'm talking about worse for the stock market, which are higher than expected for the data. But the markets were more or less understood that if you look at the prior figure, that inflation is still coming down, but not as slowly. So yes, yes, it is a bit, it is sticky. Korea says it's says it's sticky. But that is what we'll. So next release we have coming up is the US PPI report. So if the inflation report has had this sort of reaction, with one figure or with a couple of figures being higher than the forecast. If the PPI data is the same, whether there's a couple of figures that are higher or lower than the forecast, then that might mean that we might as well, what we could see is maybe a smaller reaction to the PPI report. But let's bring up the live stream link to the video here, and I'll get that for you, and I'll put it in the chat for you. Now, full report is actually here. There it is. That is the full report for the. I'll get the full report for you. Actually, let me just copy in the link for you. Okay, there we are. Yeah, that's the link. Okay, now don't forget to like the video, share it, subscribe to the channel, get the love out there, share it with your fellow traders and friends. Also, don't forget to, if, as said, we're looking at the data on the FinancialJuice website. So FinancialJuice is a live voice and text service, okay, which is what investment banks use to manage their risk or capitalize on potential trades. So why can't you do the same thing either, or have access to what the big boys have? Now, this is the FinancialJuice site here. So you can see we have the live voice here, the text headlines, or the feed here with the text, the economic releases on your left-hand side with your calendar. Everything's all in one place and nicely done. You also have the expectation, or you also have the need to know market risk as well, to give you an expectation of what could affect the market or what has already had an effect on the market. Okay, that's what the need to know market risk is all about. But you have all your data in one place to have a look at for your live voice and text service. So if you haven't, as said, you use more or less use the live voice and text service to manage your risk, capitalize on potential trades that you could have, that could appear. But what I'll do is I'll share the link for the FinancialJuice homepage so that you can then sign up to the FinancialJuice site. As said, it's completely free. Okay, to sign up to the FinancialJuice site, FinancialJuice feed, and what you can do is you can use the delayed version, but the delayed version has adverts playing. As said, there's a global delay on the website, and of course, with the economic releases and headlines, if you're a day trader, you want to have the data. You want to have data there and then, rather than having to wait. Okay? You want to capitalize on potential trades, opportunities, or manage your risk as best as you can. So this is so you can sign up to the FinancialJuice homepage, FinancialJuice newsfeed. But But then you can also go pro as well, which is where the little button that would appear here on the free version. And then you can decide to do whatever you want to do, whether you want to go with a full version of FinancialJuice. If you do decide to go ahead with a full version of FinancialJuice, then what you'll need to do is first of all create an account. Okay, if you just want to go straight to pro version, create an account on FinancialJuice, then verify your email, and then go back to the FinancialJuice homepage and click on the Go Pro button, which I said is which is where the FinancialJuice logo here is on the website in the top left-hand side. And then once you've done that, then once you've paid for the service, then go back to the website, then log out, and then log back in again, and then you'll get the view that I have here of the FinancialJuice site. Okay. If you do have any issues, of course, always let us know, and we can try and help sort it out for you if you do have any issues. Expected is what it means forecast. Yep, that is correct. Nazareo. That is what I mean. What is the expectation and what is the forecast? Now, that's the FinancialJuice homepage. So, of course, if you wanted to have access to the deviations for the economic release, okay, if I just bring that up again, I'll bring it up here for you. Bring it up. Here we are. So then deviations for the economic release, okay? I want to kind of explain how this works to you, even if you currently use it at the moment or look at it at the moment. What I want to do is show you what the deviation is all about. So the deviation shows you how much the market reacts to an economic release, depending on what the figure is and how much of a deviation there has been between the forecast and between the actual figure and the forecast. Okay, and that will determine how the markets move. So of course, it wasn't as strong as a movement as we'd seen in the past. It is actually becoming weaker than what we've seen in the past. But here is what I want to show you is that you can see. So again, so the initial figure here shows you the initial movement going to the wick of the candle and showing you the direction if it's going up or down. The figure in the brackets shows you the movement 10 minutes after the release. Okay, and it goes to the end of that candle on a 1 minute chart, by the way, just to let you know. If it doesn't have a word saying going up or down, it basically means it's in the same direction. So if 139 ticks down, and the bracket here in the bracket says 4, it's 4 ticks down, or pips if we're looking at the currencies. Unless it's otherwise stated that post 10 minutes of the release that the asset has actually gone up rather than down 10 minutes after release. And that's quite important to know as to how strong the initial market reaction is and how long that really lasted within the markets. So again, something that people have been asking, is it free? Can I get access to it? Yes it is. Don't worry. I've got you back. It's always free. It's completely free. Do not worry, my children. But yeah, so you can have access to that. All you got to do is sign up to the MACROACE mailing list. And I'll put it in the chat here. There you go. That is how you can sign up to the MACROACE mailing list. So it's not just for the CPI report, but there's also we also have it for the other reports too, for non-farm payrolls, the FMC, other ECB rate decision, Bank of England, and so on. One thing I want to finally show you as well, so TICKSTRIKE, if you've been looking at it here, very useful to kind of understand how strong how strong is the buying or selling momentum within the market. TICKSTRIKE allows you to listen to the order flow within the market, and it gives you a visual and audible reminder, or it gives you a visual audio alert of what's going on within the market. So what is TICKSTRIKE? What is this ticker here? So this little box here, okay, shows you, so you've got the S&P here, and you've got numbers, and you've got a slide, you've got a minus figure, and it's going red and blue. What's that all about? So a minus figure shows you when there's selling momentum, and a plus symbol shows you when there's buying momentum. Okay. And here's a slider which changes the level of sensitivity of what you're looking at. Now, 1 is the most sensitive to market reactions. So when there's a little bit of buying or selling that kind of goes on, then then TICKSTRIKE will pop off, and as it did there, it gave you a little bit of a, there it's going now on the S&P. There's a little bit of buying momentum, and then it kind of goes off and then moves. Then if you wanted to move the slider higher, all the way to 15, or chop and change wherever you want it to be. 15 is the least sensitive to market reactions. So only when there's a big amount of movement that's happening within the market, or the asset or assets will then TICKSTRIKE go off and give you an audio alert. Okay, so I've kind of got it at 8, just kind of midway-ish point. But if I was to leave at 15, you see, there's still not, there's not enough momentum for TICKSTRIKE to kind of be, to trigger, okay, to give you an audio or visual alert. That's TICKSTRIKE there. TICKSTRIKE, I'll put that in the chat here as well. And then, of course, we have unusual activity. So if you like trading unusual volume activity in the stock market, in currencies, in crypto and futures, then you can also have a little play with our free beta test version of the service, a new service that we're bringing out. It's not that old now, still quite fresh, but we want you guys to join up, have a beta test, join a beta test group of the service and give your thoughts and feedback as to what worked, what didn't work, and what can be improved, what can be changed, and what can you do, and what can we do to make the service better. Okay, so that is it from me. I will see you guys on Thursday, same time again at 8 a.m. Eastern time for PPI data, and we'll go from there. All right, thank you very much. Don't forget to like the video, share it, subscribe to the channel, get the word out there, and I will see you guys soon. All right, take care. Bye now.